Good morning, fellow YouTubers. My name is Dave, and if you're new here, I just want to welcome you to my channel. And if you find this content useful or informative, please hit that like and subscribe button. If you haven't already watched my M1 tutorial/review series, I have two different portfolios which I focus on two different strategies. My main portfolio, which will be the topic for a separate playlist that I'll update more frequently, is based around a mixture of dividend growth and dividend income. If you're not familiar with those terms, a dividend growth strategy is owning shares of a company or fund that increases the amount of dividends that they pay in a fairly predictable way, which is usually about once per year. A dividend income strategy is owning shares of a company or fund that usually has a flat rate of dividend payouts, but can fluctuate up or down depending on the market. Anyways, I also have a smaller portfolio, which is my growth portfolio. The overall idea of this one is to own shares in companies or funds that do not pay a dividend, but are in their growth phase, which means that instead of earning dividends each month, quarter, or year, I'll be dependent on those companies to grow their business, which will then increase the amount that their shares are worth. These types of stocks are, in general, much more risky than dividend stocks, as those companies, when I say those companies, the dividend stocks, don't usually have much growth as far as their stock price goes. That isn't to say that their stock price won't go up, but not as much as a growth company. We're talking on the order of, say, a 2% increase in share price for a dividend stock versus a 250% increase with a growth company. How do I invest in both of these portfolios, though? Well, as I am primarily after dividend income, I invest the majority of what I can afford to invest into my dividend portfolio, and a smaller amount into my growth portfolio, which I chose right around an 80-20 split, which means that when I invest, say, $250 a week into my dividend portfolio, I'll then invest $50 a week into my growth portfolio. So, that's $300. $250 into dividends, $50 into growth. Now, the reason why I chose this percentage is because my overall risk tolerance that I have in regards to market fluctuation and how the prices always go up and then crashing right back down. As I like to say, it is what it is, right? Now, of course, I'm not a financial advisor, so it's up to you on how you choose to invest if you do so. But if you're looking at starting, I personally use M1 Finance, which I'll go ahead and link below. So if you haven't already, and if you sign up with them and fund your account with $100, then we'll both get $50 since they're currently running a promotion. Also, if you haven't done so, and even if you currently do have M1, look at their M1 Plus account, as they're also giving away a 1-year free trial for that as well. So anyways, with my growth portfolio, when I originally made that portfolio, as a tech guy, I went really heavy into various technology companies and new companies that were becoming public. One of my stipulations, though, is that they had to match what I envisioned for the future and how they would have a place in that future. And one of my major concerns that I have is with climate change and how I believe that the oil companies and the oil industry will no longer be a huge thing in the coming decades. Oil will always be around because we do use oil in various plastics and even foods, believe it or not. Now, there are a few more issues that arise from climate change and the oil industry massively downsizing. but I'll go ahead and I'll talk a little bit more about that when we do a deep dive into those stocks and the funds that I own that pertain to that. Now, as you can imagine, a few months ago, my growth portfolio was becoming extremely bloated in that, I had a ton of stocks in that portfolio that I had to watch, keep track of, read reports, listen to conference calls, you name it. As someone that works at night and full time, that was really running me ragged. So I started looking at consolidating my portfolio into ETFs, which held the companies that I was currently investing in. So when I sold out of those companies and bought into the ETFs, I did make a pretty decent profit from all of those stocks that I had owned. There were some stocks that I didn't sell, but I just waited them out until I could take a profit from those. Now there is one more company that I'm holding on to, and that company is SoFi. You know, as someone that, as far as my growth strategy goes, I'm taking a viewpoint of between 5 to 15 years out. So I don't mind holding on to SoFi until I can make a profit. But once I do, I'll go ahead and sell out of SoFi, since one of the ETFs that I currently invest in does have a position in that company. But with that said, let's go ahead and switch over to M1 Finance. As you can see, I have my portfolio broken down into 5 different pies. Well, 6 if you count FinTech and SoFi. In this particular video, I do want to go over the first pie that I have set up, which is the ARK ETFs, the ARK Growth Funds. We'll look into the various holdings in that pie, and then at the end, I'll provide a summary on the reasoning behind why I chose to set up the pie the way that I have. So here we are in the ARK Growth Funds pie, and you can see that I have most of the funds that Kathy Woods and her team at ARK has released. The first one is the ARK Innovation ETF, which is their main ETF that almost everyone talks about in the media. So if we click on that and then go into details, we'll see from their profile that they invest in companies that are focused on disruptive innovations under normal circumstances. If we scroll down, we can see that 86.8% of the stocks in that fund are US based, 12.91% are non-US stocks, and they also hold 0.29% in cash, with their top holdings as, you guessed it, Tesla. Oh, and also Roku. Now, let's go ahead and go back, and we will look at ARK-F, which is the ARK FinTech Innovation ETF. This is an ETF that, as the name implies, it tracks fintech companies such as SoFi. Now, this ETF is similar to the ARK Innovation ETF, but this fund is dedicated to financial technologies. Scrolling down, we can see that 54.64% of the allocations in this ETF are US stocks, with 45.21% being non-US stocks, and they currently hold 0.15% as cash. Their two top holdings in this ETF is both Square as well as Shopify. Now, it also showing here, it does look like in this ETF, they do currently have 56 holdings. So, of those 56 holdings, 54, roughly 55% are US stocks, 45% non US stocks, and then the cash that they have on hand. All right, so moving on, we also have the ARK Next Generation ETF. And the theme of this ETF is to be focused on companies that will provide the next generation of internet technologies. Out of the 49 holdings are the 49 companies that they have in that ETF. 79.21% are based in the US, 16.41% are non US stocks, 4.13% are in other categories, which means, well, I have no idea. I'm not saying it's aliens, but they also have 0.25% that they hold onto as far as cash goes. The top positions in this ETF is currently Tesla and Shopify. Tesla does seem like a weird choice for this ETF, but there is a rumor going around that Tesla shareholders will more than likely have access to pre-IPO shares of Starlink when it becomes a publicly traded subsidiary of SpaceX. So this could be a move by ARK to get those pre-IPO shares before they are publicly traded. So that is more than likely the reason why ARK has Tesla in their next generation their next generation internet ETF. All right, so moving on, we are the next up. We have ARK X, which is the newest ETF. And since M1's data provider hasn't updated any information on it yet, let's go ahead and go to their website. So we can see from their website that the theme of this ETF is to invest in companies that are primarily in the business of space exploration and innovation. This is sort of weird right now, as they currently define space exploration as companies that are leading, enabling, or benefiting from technology-enabled products and or services that occur beyond the surface of the Earth. Basically, right now, this means companies that use satellites and rockets, and that's it. With ARK X, they have a typical amount of holdings between 40 and 55. And if we scroll down, we can also see their top 10 holdings. The top two are Trimble and also another ETF that is from ARK called the 3D Printing ETF. Now, if we want to find more information about any of ARK Invest's ETFs, you can always go to their website, which I have pulled up here, and you can actually download their prospectus, which the prospectus, it gives you more information about the holdings, percentages, and a ton more. But instead, let's go ahead and we'll just move on to the next ETF in the pie, and that is ARKQ. Now, ARKQ is ARK's Autonomous Technology and Robotics ETF. As the name implies, this fund invests in autonomous technology, AI, and robotics. Out of the 47 holdings that they currently have, 71.9% are U.S. stocks, 27.66% are non-U.S. stocks, with 0.37% currently they hold on to as cash. And the top holdings in this ETF is Tesla and JD.com. Is it just me, or is there a pattern here? I wonder. Anyways, let me go ahead and take off the hat that I made from tinfoil, and we'll move on to the last holding, ARKG. ARKG is an ETF that's based around genomics, which you probably have heard about being referred to as biotech. As such, they are in a multitude of sectors such as healthcare, information technology, materials, energy, and consumer discretionary. For those that don't know, consumer discretionary, as per Investopedia, is a term that classifies goods and services that are considered non-essential by consumers but desirable if their available income is sufficient to purchase them. For example, consumer discretionary would be your Kindle subscription. However, I don't know about you, but I consider my Kindle Unlimited subscription to be highly essential. But what do I know, right? Now, with the 61 holdings in the ARKG, with the 61 holdings in the ARKG ETF, they have that broken down into 86.36% in U.S. stocks, 12.91% in non-U.S. stocks, with 0.73% in cash holdings. The top two holdings in ARKG are Teladoc Health and Exact Sciences Corporation. So, that is it for my ARK Growth Funds pie. And as you saw, that pie does make up 25% of my growth portfolio. Now, one thing you may have noticed when we were looking through the details of each ETF is that the expense ratio of ARK is pretty high at 0.75%. What this means is that for every $100 that you invest with them, they do take 75 cents of that $100. So essentially, you buy $99.25 worth of stock, and the remaining 75 cents goes to them as management fees. Now, the reason why they take so much in expenses compared to other ETFs is the fact that they invest in, both innovation and disruptive technologies. So this takes a ton of time in research, forecasting, and just, even general management of the ETFs. Something else to keep in mind is that the percentages of non-US based stocks that they have invested into. This is particularly concerning, just due to the nature of geopolitics, such as trade wars, sanctions, and a wide variety of other different things. However, with all of that said, I am extremely bullish, which means that, I buy, and then I buy even more. Simply because I believe in their team, what they do, and their vision of the future. I also like how their team frequently updates their shareholders and the general public by the way of posting videos on YouTube that anyone can watch, especially Kathy Woods. Now, this does provide a high degree of both the visibility of ARK and the ARK ETFs, as well as transparency in their way of thinking about their investment strategies. I do plan on holding on to the ARK ETFs for a very long time. However, I do have a general portfolio plan in place where at the end of the year, I rebalance my portfolios in order to maintain that 80-20 split that I'm looking for. Now, before I end this video, I do want to make a note of the pie itself that was showing it currently being down by 4.55%. That is sort of correct, but when I rehash the portfolio to be an ETF only portfolio, with the way I had arranged my pies, I had to transfer all of my ARK ETFs into one pie. And since I had bought and sold different amounts than what I already had, M1 Finance did do a taxable event, thus showing my average purchase prices as being what they are now. Luckily for me, though, my total portfolio amount and what I had sold off is far below the minimum to actually be taxable. Now, with all that said, this is just the first part of a small series where I dive into my growth portfolio and show exactly what I'm investing in and why. I do hope that you'll stick around to the end, as I do plan on providing updates to this series just to show everyone how it is performing. Again, thank you very much for watching, and if you like and subscribe, I swear I will drink even more coffee so that I can bring you even more updates in the future. Alright, I'll see you then. Bye.